Thanks for watching this Magellan update. Today I'm speaking with Gerald Stack, the Portfolio Manager for Infrastructure. Gerald, it looks like the cash rates have continued to decline in the portfolio. Where are you allocating?
So I think we need to answer that. We need to give you a little bit of history about the fund. In mid-2014, we went to quite high levels of cash allocation in our fund. Historically, we'd been 2 to 3% cash. Back in mid-2014, we went to approximately 10% of our portfolio in cash. We did that principally because we saw that in the medium term, it was our assessment that that interest rates are more likely to rise than fall, certainly, and that there are certain parts of our portfolio and of our investment universe that historically have been very defensive, but under those sorts of conditions, perhaps not so much. So we went to a high allocation to cash. And in particular, in talking about history, we're drawing upon things or experiences like the taper tantrum. Taper tantrum back in May, June 2013 was a situation where then Fed Chairman Ben Bernanke used some language that was widely interpreted to mean that interest rates are about to rise. The Fed actually did nothing, but in the market, interest rates rose at the long end of the curve. The 10-year government rate increased by roughly 1% over around about an 8-week period. And in response to that 1% increase in interest rates, we saw approximately a 7.5% reduction in infrastructure values as measured by the benchmark, the S&P Global Infrastructure and Utilities Index. So 1% up in rates, 7.5% decline in infrastructure values. So quite sensitive to interest rates. Now that's what happened over a very short period of time. But then if we look over a longer time frame, you'll see that short-term impact moderating greatly over the longer term. Indeed, over the longer term, that short-term impact is nary a blip on the horizon. It's the fundamentals that prevail over time. So with that in mind and expecting rates to increase over time, we elected to take some cash off the table. Now, in late 2016, when the Trump administration was elected, we saw market investors generally become much more optimistic about the outlook, and as a result, interest rates again at the long end of the curve start to increase. We saw roughly a 1% increase in again the US 10-year government bond rate. Not surprisingly, consistent with the experience in 2013, we saw infrastructure values fall pretty significantly over again that sort of 6 to 8 week period in November, December. As a result of that, we found some things where we identified some things that looked very cheap to us. High quality companies, but all of a sudden trading well below our assessed valuations. And we used that opportunity in the back half, or the last quarter of last year, to invest in some assets that we felt were attractively priced. There was no single sector theme to this. There was assets that we invested in US regulated utility space, both water and energy, and also in the Australian energy infrastructure space. So it was not sector specific, it was not geographic specific. It was, we felt that there were, it was reflecting the fact that we felt that there were a number of assets that all of a sudden were trading on prices that we felt were fundamentally much cheaper than they had been for a while. And in many respects, this is the theme that we expect to see happening over probably the next 2 to 3 years. As interest rates rise, from time to time, we expect that there will be assets that we feel become unrealistically cheap, and we're looking to use our available cash reserves to invest in those sorts of opportunities.
Gerald, the oil price has been quite volatile and is currently around the $40 mark. How does this impact your portfolio?
Yeah, look, in essence, it doesn't affect our portfolio too much, certainly at the fundamental level, at the level of what they're earning. But it is worth thinking about that. Oil price over recent years has been quite volatile. We saw the oil price fall quite strongly in 2014, 2015, calendar 14, calendar 15. And then we saw the oil price rise again from circa mid to high 20s to about $50 a barrel, US dollars a barrel in 2016. And then in the most recent quarter, we've seen the oil price fall back again. So we've seen quite different circumstances. By virtue of the way that we define the universe and what we define as investable, this has limited or no impact upon the companies that are in our universe. But let's unpack that a little. The world tends to define infrastructure as being essential assets that provide a service that's essential for the efficient functioning of a community. And really what that means ultimately is demand is reliable. People use electricity every day, they use water every day, so we know that demand is going to be there. Demand is very reliable. Now that's interesting, but we actually believe that when investors go to invest in infrastructure assets, what they're actually after is reliable returns, reliable earnings and reliable cash flows. Now, as much as we like investing in essential assets, what we're seeking to do is ultimately reflect what investors want: reliable earnings, reliable cash flows. And therefore, from that group of essential assets, we will screen out anything which faces external variables that affect the cash flows. And one of those big external variables is the oil price. So if a company is materially affected by, if their earnings are materially affected by changes in the oil price, then we strip them out of our potential investment universe. Now that will mean, as a result, that an increase in the oil price, a reduction in the oil price, it really has little or no impact on the earnings of the companies in which we invest. And so 2014, 2015, 2016, the companies that we invest in, the portfolio that we invest in, has really faced little or no change to the direct change to the earnings in which they're investing in.
So rising interest rates in particular, what impact will it have generally on listed infrastructure, but in particular your portfolio?
So to think about rising interest rates and the impact on the portfolio, I think we need to think about two separate aspects of that. Firstly, what's the impact upon the businesses themselves and their financial performance? And secondly, what's the impact on valuation of those businesses? So if we think about the impact on financial performance, our universe, infrastructure and utilities, sort of neatly divides into two: utilities, regulated utilities and infrastructure assets. Regulated utilities are regulated at the point of earnings. A typical regulated utility around the world earns somewhere around the 9 to 10% mark on its equity base. The regulator sets the price for its service, whether that's water or electricity or energy, such that it earns 9 to 10% on its earnings base, on its equity base, and therefore, if inflation or interest rates or some other variable should change over time, it's able to adjust its price in a regulated setting to achieve that 9 to 10% earnings base. So as a result, an increase in interest rates has limited or no impact on a regulated utility. Infrastructure is slightly different. Infrastructure tends to be regulated at the point of price rather than earnings. So a toll on a toll road grows with inflation. The charge you pay at an airport grows with inflation in line with the contract that the company has with the government. So there, you're growing with inflation over time. And to the extent that an increase in interest rates reflects an underlying increase in inflation, well, again, you're largely unaffected because that's coming through in your pricing. So both infrastructure and utilities we would see as being largely having very limited impact to an increase in interest rates. In addition to which, what I would add is that these companies have taken the opportunity of the last 3 to 5 years to lock in their debt for long periods of time at very low rates. An example of that would be Atlantia. Atlantia owns 70% of the Italian motorway system. This year, in January, it locked in or raised a 9-year debt facility, 750 million euros with a 9-year maturity, at an all-in cost of 1.63% per annum. So very low cost of debt well into the future. And as a result, an increase in rates is again going to not flow through to these companies in any great deal. So largely, the financial performance of these businesses largely insulated from an increase in rates over the foreseeable future. So that's the impact on the business. The flip side is then, well, what's the impact on value? As we've talked about already in this video, we know from history that infrastructure and utilities are seen as interest rate sensitive stocks, and as a result an increase in interest rates can be expected to lead to at least a short-term decline in values. We saw that most recently with Mr. Trump. We've seen that previously with the taper tantrum. However, provided the fundamentals remain in place, then we expect that infrastructure values will return to those fundamentals. And one of the key fundamentals is, what do investors expect for interest rates over the future? We today would believe, it's our view that an appropriate long-term risk-free rate, a long-term 10-year government bond yield rate in the US is something of the order of 4%. And we think that's consistent with what the market expects. When we look at the way that assets are priced around the world, and particularly in the US, we see that those rates are built in to the way those assets are priced. And therefore, while rates will rise and we expect to see some short-term volatility as a result of that, we don't believe that the fundamental value proposition is threatened by an increase in interest rates up to and or around that 4% level. If our interest rates were to go significantly beyond that, absolutely that would be an issue for the valuation of infrastructure assets. But up to 4%, we see it as largely inconsequential. And I might add that the prevailing rate today in the US is around about 2.5, 2.6%. So in that 10-year rate, we're allowing for an additional 1.5% of interest rate increases over, let's say, a 3 to 5 year time frame. And on that basis, we would see things as relatively fairly priced today. So impact of interest rate increases on the businesses, limited if any, impact on valuation, perhaps some short-term volatility, but we don't believe that there's a long-term impact on valuation.
Thanks, Gerald.
Thanks, Frank.
And thanks for watching. Please feel free to forward this video link on to colleagues or clients, and you can find out more information from our website. Thank you.